All right, in this video, we're talking about itemized deductions now. Now, prior to the Tax Cuts and Jobs Act of 2017 with President Trump, there were a lot of other itemized deductions that were available, and a lot of them were just dependent on your AGI. So like certain medical expenses over a certain percent of your AGI, or other things like that. Well, it has been drastically simplified now. So I'm just going to talk about the current itemized deductions as they stand right now. Again, this can change and is set to currently change by the end of 2025. It will revert back, and those other deductions, how it was before in 2017, it will come back unless Congress makes another change. So all these things are subject to change and do change from time to time. But I'm going to focus on the right now and for the next several years as it is set to be. Okay. So the itemized deductions, essentially, there are three itemized deductions. The first one is mortgage interest. You can deduct the amount of interest that you pay on a mortgage in a given year. This can be on your first and second home. So if you have one home or two, if you have two properties with mortgage, then it counts. Obviously, if you have a rental property, then that's different, right? That you can deduct that, it's a rental, so that's kind of an expense, a business expense. But we're talking about primary use homes, personal assets, first or second home. Now, let me talk about the changes. So you can deduct up to $1 million worth of a mortgage if purchased before 2017. So if you bought a house in 2015, you've got $1 million worth of a mortgage, you can deduct all of that. If you purchased the home or the property after 2017, you can only deduct up to $750,000 worth of a mortgage. So that still may be a lot. You're like, yeah, I'm not even getting close to that. That's totally fine. So you can deduct all of that up to that limit. Okay, so that's the mortgage interest deduction. It's not subject to a cap other than the total size of the mortgage that you took out. If you get a $1.5 million mortgage, you can only deduct the interest paid on $750,000 worth. Okay, does that make sense? Next deduction is state and local tax deduction, or otherwise known as SALT. Now, this is the biggest change that this went through is it has been capped at $10,000. So there are some states, famously on the coasts, that charge really high state taxes and also sometimes local taxes, right? Your city might charge you a tax. A lot of areas of the country that does not apply, but there are some cities where it does apply, and taxes are extremely expensive, state and local tax. And then this also includes property tax. So before it was not capped, there was no limit. So if you paid $50,000 in state and local taxes, then you got to deduct that. It has now been capped for $10,000. That is the max that you can deduct. Some people might still not even get there in most of the country, but it really hurts those that are typically on the coast, right? Think New York, think California. This one hurt a lot. Okay, so again, it includes state and local income tax and property tax. You add up the total, but then you can only deduct the total amount or $10,000, whichever's less. And the third deduction here is charitable contributions. Now, these contributions and the limits here actually have changed as well based on COVID legislation that was put through. Generally speaking, okay, before the COVID legislation, here's kind of how it worked out. You were allowed to deduct up to a certain amount, okay? So if you donated cash, and this has to be to a qualifying nonprofit or charity or foundation, if you donated cash, you were allowed to donate up to 60% of your AGI, and then you were capped. Okay, you could deduct up to that amount, but no more. Now, based on COVID legislation, you can actually donate up to 100% of your AGI in cash and get a deduction for it. Okay, so those are some massive donations, but definitely possible. Okay, now if it's property, so you can donate actual property and receive a deduction for the fair market value of that property. So maybe you give clothes to, a thrift store. You could deduct the fair market value of those clothes or those items. Okay, you just keep track of it on your own. But you can also donate investments. Like if you have stocks, long-term appreciated stocks, you can donate those and you get a deduction for the full fair market value. Even if you paid $10,000 originally to buy the stock, If it's now worth $20,000, you've had it for at least a year, you can donate it and you'd get a $20,000 deduction for your charitable contribution, even though you only originally bought it at $10,000. Okay, so it's your property. They deduct the full fair market value. We'll talk about some charitable giving strategies in a future video, but that depends. You can deduct certain percentages of that. It depends on the type of organization you're donating to and the type of property. Okay, so if you are doing this, it is always advisable to work with a tax professional to make sure you are maximizing your deduction and making sure you're getting what you need. So that is as far as donated property. Now, one of the things that COVID legislation changed is that you actually can claim up to a certain amount of charitable contributions along with your standard deduction. Before, it was either or. You could either claim the standard deduction or add up the total and claim your itemized deductions. Well, the COVID legislation changed this a little bit. So if you're single, you can actually deduct an additional $300 worth of charitable contributions. Married filing jointly, an additional $600 of contributions. So you take the standard deduction plus $300 or $600. So you get a little bit of extra bonus there, depending on if you've contributed to charity. But generally speaking, that's how these three work. It's very simple. Before, again, there were a lot of other different types of itemized deductions you could pick up from. So what you do is you take the total amount, the mortgage interest deduction, state and local tax, paid charitable contributions, you add up the total, and then you compare that to your standard deduction. Obviously, you want to claim the greater amount. If your itemized deductions exceed what you would get in the standard, then you itemize deductions for that year, and that's how you file your taxes. If it is less than your standard, then you just claim the standard deduction and move on. Okay, so let's walk through an example here. Married filing jointly, your standard deduction is $25,900. So let's look at your itemized deductions, see which ones you might claim. Mortgage interest, you added it up, you got your statement from your mortgage provider, and it's $12,000 that you paid in mortgage interest that year. Okay, cool. You add up the state and local tax, right? That's income tax and property tax. Okay, don't forget the property tax on your home. So you add that up, it was actually $15,000, but remember it's capped, so we can only count $10,000. Okay, so we're capped at $10,000. And then charitable contributions, we donated $15,000. So you add up $12,000 plus $10,000, which is the cap, plus $15,000, that's $37,000. So comparing that, obviously this year we are going to itemize deductions because we get an additional over $11,000 worth of deductions against our income. So if you want to figure out how much tax that is, you take what that difference is. You would take, $11,100 times by your marginal tax bracket, right? Your marginal tax rate, and that's how you would figure it out. So if you're in the 24% tax bracket, you $11,100 times by 24%. That is the amount of taxes that you saved this year by itemizing. So that's itemized deductions versus standard. You can figure that out fairly easily. It's pretty simple calculation. And it is, again, this way, it is set until the end of 2025. Then it changes unless it changes beforehand, which it could. Just keep an eye out for that. All right, that wraps up this video. See you guys in the next one.
Simple rules, better outcomes.